Okay, good morning, good afternoon, good evening, everyone. Today we're going to be discussing about volume 1, class number 4. So this class is going to be for reversal. The last stage of the algorithmic price signature. So the last stage of the algorithmic price delivery. So reversal, right away. A reversal takes place when the market moves in contrarian direction from the current trending environment. Let me make this one smaller, like that. A little bigger. So when price reverts or inverses, it means, which is inverts, right? Inverts, yes. It means that the market makers, or as I like to call them, men in black, have taken an important level of liquidity. And now they want to develop or destroy the opposite side of the marketplace. So you're going to be looking for big pools of liquidity. So you look for big pools of liquidity. Before I ask you what those are, let me explain something real quick. Okay, so a reversal takes place when the market moves in contrarian direction from the current trending environment. This means that if you had the market doing something like this, and the trend environment started higher all the way down here, and if you are indeed looking at a value reversal here, what you're going to have to aim at is going to be this low right here, because this is where the trending environment higher began. So you can take something off inside of this range. That is okay. Take a partial here, but wait to at least the market to take out this low, because a real reversal is going to have to take out this low. If you only come back to this range, you don't pay yourself. You're going to be running the risk of the market just making an expansion retracement back into the range, 50% of the range, and then making higher highs. So this is one of the reasons why you want to be paying yourself here, and then allowing the rest, if you're indeed in a value reversal, you're going to see this low being taken out, because this is where the beginning of the move took place. This is where everything started. The trending environment, the trending higher began. So now, once you know that, you have to also know that the men in black or the market makers are the one that attack the liquidity. And when you have reversal, it's because now the interests have shifted into the other direction or to the opposite direction. And this is why the reversals take place. But these reversals are always going to take place from a specific level. And these specific levels are normally the big pools of liquidity. All right. So, do you guys know what the big pools of liquidity are? Okay, we have ERL, IRL, high and lows, probably session, 1 hour equilibrium, high lows, high resistance, return. Okay, so you have one of them, two of them, right, Kobe? And yes, JJ, these are gonna be highs and lows, but a specific liquidity, so specific highs and lows. And think about institutional levels. Think about higher time frames. What do you have? Higher time frames. I mean, is under the pretense of high and lows, right? What specific highs and what specific lows? Exactly, tickled by biddies. Tickled biddies? Um, Daily highs and lows. That's one. That's one. Good, 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 good. So institutions and banks are always looking at the higher time frame levels, and oof, and the levels they are looking at are coming all the way from the weekly highs and lows, daily highs and lows, and then the highs and lows that Kobe set, which are 1 hour or session highs and lows. Whoosh, whoosh, whoosh. So weekly highs and lows, daily highs and lows, and hourly or session highs and lows. These are the highs and lows that the market will have reversal every single day, every time. And we have three types of reversal, or at least these are the three types of reversal that I know. And the market may do 1,000, but every time the market does a reversal, I've always seen it doing it this way. So this is the first one, okay? Pay attention here. So let's say you have this swing high right here, and then you have this swing low right here, which is going to be your sell side liquidity. And the market is going higher. So because the market is going higher now, oh wait, first let me give it up for you guys who answered correctly. Yeah. Okay. And okay, now when the market is delivering towards this buy side right here, this swing high, and you're super close to it, you may think that you can take a trade towards that target still because the level hasn't been tapped yet. And that can be true, but you have to be very nimble when the market is close to that level, and you have to start measuring the wick. So because when you measure this wick right here, this is also a P derivative. And you're gonna see me sometimes that I do something like this. This wick right here is having quadrants, the upper quadrant, the 50%, and the lower quadrant. And then the low end of the wick is gonna be the body of that swing, right? Of that candle. That body is a rejection block. You already know what a rejection block is if you paid attention to the Volume 1 class introductory video that I have put for free for the students of Volume 1 in the VIP content, Volume 1 folder. So the market is going to come to the rejection block, and from here, it may start breaking lower, breaking down from the rejection block or this quadrant, and it's not going to be able to deliver towards this buy side. So it's going to fail to deliver towards this buy side. It's going to break lower, and then it's going to give you an expansion retracement model for the sell side. So why is this the case? Because the market is failing to take out this high. This is a reversal pattern. It is called failure swing. And this failure swing happens around 10% of the time. Okay, so why is it called failure swing? Because the market is failing to take out this target right here, this buy side liquidity. But where the failure swing forms, at the rejection block and at the swing. So you have to be very nimble and pay attention, close attention to these swings, because the market is gonna fail to take it out, and it's gonna respect the rejection block or the quadrants with the bodies, break lower, leave you a fair value gap, expansion retracement, and it's gonna start delivering towards the sell side. So remember the class that I told you, if you see a retracement, I don't wanna see a reversal. But if you see the reversal from the retracement, this was in the second class, volume 1, then it wasn't a reversal. I'm sorry, it wasn't a retracement. It was another thing. And the other thing is that it was a reversal. So it wasn't a retracement because this looks like a retracement, like the market is retracing back into the range before going lower, but it is not a retracement. It is a reversal. It is this pattern of reversal. It is a failure swing. But after a reversal, you're not gonna see after a retracement, you're not gonna see a reversal. After retracement, you're gonna see another expansion. So how to know if the market is going to have a reversal pattern or a retracement? You have to be looking at these specific P derivates, the wick and the rejection block. How do you know whether to look at high as a rejection block or important liquidity? So nobody knows. I don't have a way to know if the market is going to respect this rejection block and start going the other direction for a reversal pattern. This is why I recommend you to take partials at the rejection blocks. But what I can tell you is that under high resistance liquidity run conditions, this is more likely to happen. So under these conditions, always pay yourself at the rejection blocks because nobody knows if the market is going to gravitate towards the target on this go towards the target or is going to fail to do so. It's going to be a failure soon. So nobody knows. This is why you have to pay yourself at the rejection block. But on a low resistance, on a good day, the market is more likely to go towards the target and it's not going to cause a failure soon. But instead, it's going to cause the other way that the market can have a reversal. As you see that, how I went from this argument to the other argument that I'm going to teach you now. Yes. So this is the other pattern that the market can have a reversal of. And this is the classic one. But the market gets close to this level, this buy side, and then gets in, gets out. So the behavior here is what's going to be giving it away. And now you have the sell side. And then you have the buy side. So when the market leaves you the highs like this, okay, from the consequent encroachment of the rejection block, when the market leaves this high, this high, this high, this is good to target. And later in the day or in the next day, the market may come all the way back down, all the way back up to those highs, like this. And the traders that saw this drop are gonna be thinking, oh, this is a real level of resistance because the market tried to go up here, but then failed and deliver lower prices. So this means that the market is now super bearish and there are real sellers up here. So when the market gets to this level, they're going to be selling this because remember, they think the market is bouncing off of these levels. They're going to sell, the market is going to go lower, and then they're going to get trapped. The market is going to break higher, and they think the market now has changed the direction. They want to be buying this breakout higher because they think now that this level is a resistance level broken now turns support to keep pushing higher. So this is where they get trapped both sides. They get trapped on the bounce lower, they get trapped on the break higher, and they get victimized both ways, and the market starts delivering lower. So this is a classic one. After you take this buy side liquidity, the market is going to expand lower, give you an entry towards the sell side. And this is called the red on stops. It's red in buy stops. This happens 80% of the time. Okay, I see someone typing. I want to know if there's any questions. Can you explain the reversal versus retracement again? Or like write it out because I'm a little lost. No problem. So the retracement, remember the expansion retracement? The retracement is like this. The market is going to give you an expansion. It's going to come back into the range. And from here, you're going to have continuation. So the retracement is going to be coming back to the last expansion range and continue in that direction, in this direction, the first direction, from A to B. The retracement is going to go back into the A to B, is going to continue in the direction of B. No problem, brother. But the failure swing is going to do the same, but this is not a retracement because it's not going to take place from a fair value gap like normally would do. Remember the expansion retracement model? Or from another block. It's going to take place from way under inside of a rejection block. And or a consequent encroachment of a wick. This is the wick of the swing low. So this is the difference. This is the only difference, JJ, the market will retrace deeper, 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 and keep pushing in that direction. But when it takes place in the rejection block or the consequent encroachment of the wick, that is when you expect this delivery like that. So let's say you're bullish for this day, okay? And the market's been going lower, 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 lower. So you're bullish and your target is all the way up here. This is your buy side on the 1 hour. So you expect some sort of sell side to get taken, right? To see the reversal. Take the sell side and now go the other direction. But under this premise, the market is not going to do that. The market is going to come all the way low, all the way low, all the way down to the rejection block. And the rejection block is going to prevent the market from raiding the sell side. And from here, you're going to have the reversal higher now towards the buy side on the 1 hour. So it's not the same as the expansion retracement, because in the expansion retracement, you want to see the 50% and the fair value gap and order block holding price. But in this pattern of reversal, the market is going to go through this speed race and it's going to visit all the way to the consequent encroachment of the wick and the rejection block. So the lowest speed race, right? It's going to fail to take out the sell side before the reversal higher. That is the difference. I have some examples in the homework channel that I can show you also. But don't you worry now. Wow, that is super cool, dummy, what you did there. I like it. So, as to make it simpler, when you're looking for bearish prices and you want to see the high being taken before going lower, the market does not take the high but fails to take the high from a wick or from a rejection block and then delivers lower prices. That is a failure swing. That would be the little pattern right there. So now the last way that the market can have a reversal is the following way. And I like this a lot because nobody is expecting this way. Oh, one thing. You guys should send me a DM asking for the volume 1 class 1 video because I remade it. And now the video that I just did is better. And because YouTube is, remember, having problems with the old videos. So I don't want to keep having those problems. So I updated them and I'm going to putting down the volume 1 classes 1 and the whole volume 1. Volume 1 class 2 should be up now, dummy, but still gonna be uploading a new one. Okay, so what you have here is this. Okay, so when the market comes all the way back up here, to this swing high, okay, so the market comes all the way back to this buy side liquidity. What are they gonna be thinking? They're gonna be thinking this is a swing high broken or a resistance level broken. Now I'm gonna be turned as support. So they are believing that this is gonna be used as support. And because they see the market staying here in this range without being able to go lower, they now think that this is a reliable level of support or buyers. So if you are using the patterns that I told you that are not patterns, are narrative, but if you use them as patterns, you're going to believe that this is the consolidation model. And you know that after the consolidation model, you can have a reversal, but only a continuation, another expansion. So you expect this, right? But if you use it as a pattern and you try to trade this to go higher, you're going to get ripped because this right here is not a consolidation. Remember in the day that I told you that after a consolidation, you're not going to see a reversal? Just like Dummy showed you there. That is what I don't want to see. But if you have a reversal after a consolidation, then that wasn't a consolidation. That was another thing. That was an accumulation. So this is an accumulation. And this is accumulation of shorts. Because if we are bearish, smart money is bearish, and they want to sell then at higher prices. Because if you're bearish, you want to sell high, right? That is simple. So they need to bring the market all the way up above this level of buy side liquidity for the smart money traders to accumulate short positions and start selling here inside of this range. So who are they selling to? They are selling to dumb money or retail traders, uninformed money. So they're going to be buying, thinking this is going to keep pushing higher. While the smart money are accumulating short positions here. So they are selling to the retail traders before the market drops lower. So here, what you have is the difference. Once again, dummy, the difference between consolidation and accumulation is the following. So you know that consolidation can only deliver continuation. But this is not a consolidation, it's an accumulation because it's delivering a reversal. How do you spot the difference? The consolidation will only take place inside of a range between the beginning and your target. This can take place like this, all the way to the target, your buy side liquidity. Right? So you can have a consolidation here, here, and here. But the accumulation will take place at the extremes of the range, around liquidity. Bam. And that's going to show you or give you a reversal. Why is this true? What is the reason behind it? Because accumulation has a name for a reason. What is it accumulating? It's accumulating orders for the other side to be delivered. Okay? In this way, it's going to be used as a reversal. And I have shown you this in the homework channel. So when you go to homework, okay, give me 1 second. Let me find the folder. That sauces. sauce. So pay attention to what I'm going to share with you now in the chat. So what is that? Look at how the market is behaving below the sell side liquidity and above the buy side liquidity there. So if it is indeed an accumulation, it should reverse. It should go in the other direction in which the market started the move lower or the move higher, right? Where it began the trending environment. So look at this picture now. And I gave this to you on the homework channel, and then you see the whole drop lower. So for those of you who are only watching the video and cannot access to the class, let me give it to you real quick. I'm almost done. I am showing them this. So this will be the accumulation. You see how the market spends time around the liquidity and above the liquidity here? If it's going to indeed start delivering lower prices, it should turn around like it did here. Higher prices, bam, and now it's going to make an accumulation for the other side. So what happens later? It should take out these lows, right? Because it's a reversal. I don't know where I went, bro. Anyways, bam. So from all these highs towards these lows. All right, so I'm gonna be doing the trade review for today. And I have some goodies for you, right? I have something very interesting for you to share. So the trade review for this lesson is gonna be the following. So my trade normally have certain type of complication to them. Not that I am trying to overcomplicate things, but there's always a deeper insight behind the trades that I take. And because this is the last class for volume 1, I'm gonna try to keep it on the topic, right? I'm not gonna go over the other things, but I am just going to give you enough little candies that would help you to become more confident when looking for this yourself. So what we have here is the market taking all this sell side that I gave you on Wednesday, right? Gave you this level in which ended to be the low of the day. And from here, the market made a deep retracement, right? So the market makes another low, and this one right here sells a liquidity. What do you have up here? Relatively good highs, right? So you have a high and then another high, which are super close to each other. So if I go to the hourly time frame, in which I normally look for my higher probability targets, remember, this swing high and this swing high are both super close to each other. So in the 4 hour, you only see them as a high is another high, but in the 1 hour, you actually can see that these are swing highs, super close to each other. Then you have another swing high here. So all of this is layered buy-side liquidity. Have buy-side liquidity up here, buy-side liquidity up here. So when you have layered buy-side liquidity next to the other buy-side liquidity, that is high probability, super high probability target. So my attention, the place that I am trying to bring your attention to, is always to the targets. Because if you know how to pick the right targets, then you should only be looking for a trade towards those targets, right? Your model has to be presented towards those levels that you're marking on the 1 hour or 15 minutes. And right away, by knowing where the market is more likely to go, by having a target, high probability target, you have 80% of the battle done. 80%. Okay, 80%, because you already know what the market is going to do or where the market is going. So the only thing you should do now, the other 15% is going to be the psychology. And then the 5% that is remaining is going to be executing your model correctly. Okay, so that is kind of the way I see it. Because even if you have a bad entry, even if you have a shitty fill, even if you are not executing your model on point, you're kind of chasing your entry, but you have the drawn liquidity right, the market may not give you that much of a hustle. It's not going to give you that much of a headache, and it's going to keep delivering towards your target. Okay, so now that will not be ideal, but it's going to be the result that you were waiting for, which is the market delivering towards that target. So now, in order for you to make money, you first have to backtest this idea a lot, right? Where the market is going to go with highest probability, and how could you hop on the train towards that target? So, for example, for the reversal, here's what you have. Where did I tell you that the reversal is going to take place every single day, right? So you have weekly highs and lows, right? Daily highs and lows, and 1 hour session highs and lows. So this swing low right here is what? This is the 1 hour swing low, but at the same time is the previous day low. So this is a daily low, right? So the market leaves you this swing low. The next day during the London session, market drops down that swing low, and my entry is around here. Now I'm gonna explain why I took the entry there. But what you have in this side is a last down close candle before the up move, which is a change in the state of delivery. So what I'm doing here, I am measuring. Here comes the little complicated part. It's not that complicated. So around this 25, which is the lower quadrant of this bullish shorter block, is where the market is going to dip under this low. So where I'm trying to find my entry is going to be around this previous day low, right? Around this previous day low. Now, whether the market is going to reach toward this sell side or not, I could just wait for the market to show me signatures that it wants to deliver towards this sell side and then starts delivering higher. Because this is Wednesday low, right? This is a daily low, but this is also a daily low. And if I am bullish like this, chances are the market is just going to take one level of liquidity, one daily low, and start reversing. How would I know if the market is going to just take one or it's going to take the two and keep going higher? Well, first you have to remember that this sell side was already purged, and it was a big pool of liquidity because we had this swing low for weeks, okay? So this is a big pool of liquidity that already been taken. I don't have to take it again, right? That's the first thing. Second thing, I can drop down to a 15-minute chart and measure that idea. So now that I see it, daily level, I see the hourly level, which is the liquidity. What else do I have to the left? So below this swing low, I have this bullish fair value gap, right? This can be understood as your total submodel as well. Whenever you have a fair value gap below a swing low, a little gem, candy as promised, that is going to be a higher probability turtle. But don't enter right away. You have to go deeper into the time frames to reassure this idea or to quote unquote confirm this idea, right? And you're going to be able to confirm that in relationship to how price behaves around this level. Now, your idea is for buy side. As you can see, super clear. Clear buy side, buy side, buy side, buy side, buy side, buy side. Now, you have to look for your model inside of this premise, right? And I'm going to show you what model I used or what approach did I take to start looking for the delivery towards the buy side for higher prices. So you can see here, I also in the live stream gave you this bullish fair value gap on the hourly, because what I wanted to see is the market come back to this gap and start delivering higher prices, which it did, exactly what I expected. But now, the market takes out this sell side liquidity, this previous day low, this 1 hour swing low, into the gap. Now I drop down, you can go to the 5 minutes, you can go, well, in the 5 minutes, what do we have? We have the market coming in to the gap below the sell side. What does the next candle immediately do? Rapidly reacts from the low back into it and above the consequent encroachment of the fair value gap. And the next immediate candle, higher prices closing back above the gap. So what is this reaction? So what is the market showing me here? This is a rate on stops. How do I know? Because the reaction, remember that I told you that the market is going to show you by the reaction. So now, get in, get out. What is it doing here? Getting in, getting out. Rate on stops, right? So what can I look for? Another change in state of delivery, bullish order block, and the high end of the bullish fair value gap. I don't expect you to trade this. Okay, first, I don't expect you to trade this because as you know, as the order block, the whole group of down close candles before the up move. So this whole thing would be your bullish order block, right? I would pay attention to the high, the low, the opening, and the 50%. So this will be the opening. As soon as the market closes above, trades above the high, that's making this a bullish order block. But then when the market closes above it, you can see the market is trading around the opening price into this volume imbalance, and kind of is having a trouble going lower. Because under the rate on stops, you're not always going to have a return to the 50% of the expansion, okay? Especially when you have a balanced price range. So under the premise of a balanced price range, and under this reaction, I'm not expecting for a 50% retracement. So sometimes you're not going to have the 50% retracement, and that is what you want to see, because the market is going to give you the best trades without retracing to the 50%. So I want to teach you now. When you drop down to the 1 minute, what do we have? So pay attention to how the market is going with the speed and velocity through the previous day low. This will be the liquidity. Speed and velocity, bam, fills the gap, right? What does it do from here? It starts delivering the same way that it delivered lower, starts delivering higher, right? So the market is delivering lower with gaps. So this is one gap lower. And this is another gap lower. And how is it delivering higher? With another gaps. One gap higher, another gap higher. Now, the place in which these gaps converge, that is the place that is going to be treated as a balanced price range. Why is it balanced? Because these gaps are sell side imbalance, buy side inefficiency. So these gaps are inefficient for the buy side here in this range, this gap as well. But this is already being rebalanced because the market is coming all the way back up with the same delivery with another fair value gap, but in the opposite direction, overlapping the previous gap. So this gap on the opposite direction of this one is overlapping the first one. So you have a bearish gap being overlapped by a bullish gap. Whenever you have something like this around a level of liquidity, big pool of liquidity, like previous day low, okay, remember? Then that is going to be super high probability for this to be a value trade towards your target. Okay, and this is an occasion in which I will not wait for the market to retrace to the 50% because it doesn't have to. It just has to come back for the 50% for what reasons? Remember, to deliver an efficiency efficiently and to allow discount into the marketplace. In this case, it doesn't need to do that because there's nothing inefficient below the 50%, right? There's no inefficiency. This fair value gap right here is efficiently delivered. This range right here, from this drop lower to this pull higher, from this drop lower to this push higher, is all efficiently delivered because there's no these gaps right here are not inefficient anymore. You have the delivery lower here, single pass, delivery higher here, single pass. So this is all done. This is all done. This is all efficiently delivered. This is good. Okay, so this is why I don't expect to see the retracement back into these gaps. So what you could do is pay attention to the area or the range above these gaps. So I'm gonna converge these gaps in the little range that I see them both being united. That is gonna be my balanced price range. So for example, this is the range that both of them occupy. So this will be BPR, balanced price range. So from this range high to this low, everything is efficiently delivered. So the 50% will be understood from the swing high to this high end of the balanced price range. And now is where you pay attention to this. This will be what? An inversion fair value gap. So the market is delivering into a gap, blam, and bullish order block. Whoa, shit. What? Yes. And this will be here remaining as a breakaway gap, right? This will be your breakaway gap, which is one of the things that I want to see when it comes to delivery towards the target. More about this later. So this is what you have, inversion fair value gap. The market trades above it, close above it, uses the high end as support. One more time to the bullish order block into the inversion fair value gap, 50%, respects it with the bodies, starts delivering higher prices. Then spools higher, then leaves you a gap again. This is a NIOFET, right? So one thing that I have to tell you as well. So right now I've given you plenty of gems for your back test. I told you will learn many things on this review. But another thing that I want to tell you is that remember the volume 1 class number 2 consolidation model? Where did I tell you that you're going to see your breakaway gaps forming? Breaking away a consolidation. All right? Another gem. Not only then, but also breaking away a balanced price range. Because a balanced price range, it is already done, and this is going to be forming under low resistance liquidity run conditions. The first gap that forms breaking away from the balanced price range. Because a consolidation is a balanced price range. Once you break above it or break through it and you come back to it, that's why the high end supports price higher, because it is a balanced price range. But this delivery is also a form of balanced price range. So this is another way of categorizing it, okay? But it's not going to be formed in the same slow and steady pace, but it's going to be formed on a drop down and high fast, right on stops, right? So put the pieces together here. You're breaking away a balanced price range, such as the consolidation, but here you have the balanced price range because of the gaps, okay? And when you break away of that, you have this breakaway gap, right? That is one of the things that we form after breaking away a balanced price range, breakaway gap. So the second one is being utilized because we are closing the 50% of the CV. So the market is forming a bullish fair value gap here in the lower part of the inversion fair value gap, and it is trading at that support. And from here, the market doesn't see anything lower than that, right? You have your beginning of the move to this swing high, okay? Retracement kicks in, you deliver to an inefficiency to discount, and buy program starts. Look at this. Do you see 50%? Look when the market reacts. Bam, higher. Okay, then you have a NIOFET. But that is another gem. So I am entering expecting that the market comes all the way down here. I don't have an entry yet. Comes and closes back into the lower end of the 50-minute value gap. Then the market trades back inside of it. But this time, I don't expect to trade like this, okay? But if you pay attention to this Friday's live stream, many times I utilized last week's last candle's week's high as an entry or as a means of measuring price willingness to start pushing into my direction. Okay, so the market then opens, trades lower, and as it's trading lower, I'm trying to aim at the consequent inclusion of this week. So I'm entering 5 contracts right there. Stop loss will be below this consequent inclusion of this week, and then it starts pushing higher. So when I see this, that is beautiful for the trade because it is leaving me this signature. So it is a beautiful trade when the signature is left balanced price range. Okay, so my entry is before the balanced price range, the market starts pulling higher, uses the high end of the bullish value gap as quote unquote support, and then just keeps the momentum going or the rhythm going. And this will be your bullish breaker. So I understand how this would take much more confidence to take, right? The trade. So if you're not entering here, as soon as you see the market doing that and closing here, and the market opens, trades lower, this can be an entry, right? So this can be an entry, but you're not sure yet because the fair value gap is not formed in the same range. When the market trades higher and closes here, as soon as this candle opens, that can be also an entry. Or what you can do is wait. Wait for what? Wait to measure how the inversion fair value gap is going to be behaving, right? For example, here you have an inversion fair value gap, and down here you have an inversion fair value gap. So now the market closes above this 50% of this inversion fair value gap. I want to see if it respects it. Doesn't even come close to it, closes back above it. Does it touch the high? Doesn't even touch the high. Goes all the way and closes above the 50% of the first one. So it touches the 50%? Yes. What does it do? Respects it. And then it leaves me another fair value gap. So I measure that, reacts from that, and this places higher. So this is the market telling you that you're on site. So now, when you're on site, you're going to see the signatures being presented like this. Then leaves another volume imbalance with a bullish order block, respects that 2 times, and then starts pulling higher. Then the bullish breaker holds itself, bullish value gap, bullish order block, bullish value gap, bullish order block, bullish value gap, then goes all the way to this high. So I was waiting for this one to take something off, but I ended up taking it later before the market opened. Then you had the retracement to take the sell side and the continuation higher. So this swing high to this swing low. Have your last chance as an expansion retracement. And here you also have the bullish fair value gap. Pay attention here. This bullish fair value gap that I marked in the last stream. So why I am not measuring the market all the way from the swing low, right? See, this is the swing low that began the move higher. Oops. Because this range is balanced. Remember, this range is balanced. This is a single CV with a single BC from a previous day low. Bearish delivery with a CV. The same thing that I explained to you in the 1-minute chart. Bullish delivery with a BC. The place where they converge is going to be the balanced price range. So it's going to be here, balanced price range. This little place where they converge. Now I'm going to measure it from the high end of the balanced price range because everything below it is already efficiently delivered. So this is the 50%, and the place for the entry would be here. So I have group of down close candles before the up move and the bullish value gap, expansion retracement model. This will be the bullish group of down close candles. You can grab it from here. Why? Because this is the beginning of the group of down close candles that is below the 50%. So this is, remember, order block value gap below the 50%. So good. Now the market takes sells high liquidity, engineer liquidity, and it comes back to the equilibrium, inefficiency, and order block, delivering 2 things on the retracement. And then this can also be considered as a reversal if you're paying attention to the intra range delivery, right? But then the market starts pulling higher, 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 and then I had my targets here and here, and then previous week low was the best case. This will be the trade for this day, in which the market offered 500 handles, so 2% delivery for this day. I hope the review was good enough. I think it was beautiful. It gave you something nice for you to study. And this will be everything for today. Be safe. Talk to you soon. God willing. Bye bye. Good Photoshop.